Welcome to FuturesOptionsETC.com's online video trading tutorials on options. You can also contact us at training@FuturesOptionsETC.com for any dedicated training needs. You can visit our website FuturesOptionsETC.com and see through all the different articles. In this set of option trading tutorials, we'll cover the short straddle option trading strategy. A short straddle option trading strategy is very similar to a short strangle. The only difference it has is in terms of the strike price of the options that we select. The scenario to trade short straddle is when you don't expect that the underlying stock price will move much, and basically your assumption is that the underlying stock price will remain confined to a small range. So say IBM is currently trading at $50 per share, and you believe that this price movement will not be much and it will remain confined to a range of $45 to $55 in the next 2 months time. So we'll go for a short straddle in this case. You can also trade on short strangle, but that is covered in a different video tutorial. So to constitute this particular short straddle, what you need to do is you need to short one IBM call option with the ATM strike price. Now this ATM, since this underlying is trading currently at $50, the ATM strike price will be $50, and suppose from this short sale you make you gain an option premium of $5. Similarly, also short one IBM put option at the same strike price of $50, which is again ATM, at the money, and you again receive another $5 as option premium. So total option premium that you receive is $10. Now this short straddle option trading strategy comes with a limited profit but with unlimited loss potential. Also, since you're shorting two options here, there's a need for margin money which can be very high. Additionally, your profits might be limited because of high brokerage, because at the entry you are entering into two options, and at exit you might have to exit both the options by squaring them off, or at least one of them might get exercised, so brokerage cost may get involved. Now assume that your prediction comes true, IBM stock stays in the $45 to $55 range. Then what will happen is both these short options will expire worthless for the option buyer. As an option seller, you receive and you get to keep the option premium that you received, which is $10. So your profit is 100%. But in case of loss, say if your prediction does not come true and IBM stock makes a big move, suppose it goes up to $80, then what will happen is that the short call option will get exercised and you will have to pay the differential, that is $80 minus $50. 50 in this case is the strike price. So this will be $30, but you have received $10 upfront as an option premium, so your net loss is $20. In terms of percentage, this loss comes to around 200%. On the lower side, if the stock price comes down to $20, then again the put will get exercised, the call will expire worthless, but you will again end up losing the same $30. So the net loss, considering the option premium of $10, the net loss comes to $20. In terms of percentage, it is 200% loss. This loss will keep varying depending upon where the underlying stock price actually ends up. So the short straddle option trading strategy comes with a limited profit potential, where your profit at the max is limited to the total option premium you receive from the sale of the two options, but it comes with an unlimited loss potential. So it's a dangerous strategy to trade. It is advised with strict stop losses on both the option premium as well as the stock price movements, and only advanced level option traders should trade this. Now let's get into the payoff functions for these short straddle option trading. Here we will have a call option which is at strike price of $50, and this is how it would look like. And then we have a short put option again at the same $50 strike price. So this is how the short straddle constitution would be. And now that we have the two payoff functions for the call and the put option plotted, let's add them up together. The simplest way to do it is that between 0 and 50 the green graph is 0, while the blue the red graph is slanting upwards if I look from left to right. So something slanting upwards plus a 0 will give me the same slant. This is how the net payoff function would look. Similarly, in this region above 50, the sum of these two will yield this particular payoff function. However, we have still not considered the option premium in this particular payoff function. What we have received is $10, 5 from the option, from the call option, and another 5 from the put option sale. So since it is a net received, we are going to consider it as positive, and hence this net payoff function, which is a blue color, should be shifted upwards to $10. So whatever is at 0, that is this peak point which is at 0, should go to 10, and whatever is at minus 50 should go to minus 40. So what we are going to receive is this. Similarly, whatever is at minus 50 here would shift to minus 40, and this is how the net payoff function for a short straddle option trading strategy would look like, considering all the pricing and the option premium received. What this red color net payoff function tells me is that there are two break-even points. One is at $40, other one is at $60. By break-even points, these are points of no profit, no loss. So on either side of these break-even points, there is a profit area and there is a loss area. So between 0 and 40, if you look closely, then this net payoff function is negative, that is, it is below this 0 line. So this indicates a loss area, and the way to look at it is at 30, if the underlying price ends up at 30, I'm going to make a loss of minus 10, and if it reaches minus 15, then I'm going to make a loss of 25. If the company goes bankrupt and its stock prices reaches 0, then I'm still going to make a loss of 40. So my loss is increasing linearly between 0 and 40. Now let's concentrate on above 60 region. Same thing repeats here. As the stock price keeps moving, my losses are increasing. At 90, I am going to suffer a loss of 30. At 100, I am going to suffer a loss of minus 40, and this might continue further. So this is my loss region number 1 between 0 and 40, and this is my loss region number 2 above 60. What about the profit region? The profit region is confined to this particular triangle. So you can see here, this is my profit region, where my maximum profit comes at when the underlying stock price ends up at $50 per share. So at $50 per share, if the underlying price closes on the expiry, then I am going to make a maximum profit of $10, which is the option premium. On either side of this 50, that is between 40 and 50, my profits will increase linearly but with a low magnitude. So it goes from 0 to 10, and above between 50 and 60, my profits again start to decline, and eventually at this break-even point of 60, the profits start turning into losses. So this is what we have for short straddle option trading. What I am betting on is a limited profit potential, which is confined in this triangular region of minus 40 to 60 for a maximum profit of 10, but I'm exposed to two big risky areas, one on the lower side and one on the higher side. So only advanced level option traders should trade the short straddle option trading strategy. Time decay is helpful for short straddle, but it comes with a very big risk.